The trade that hurts most often begins when you mistake heavy activity for confirmation. Price breaks a level, volume swells, and you assume the market has finally declared its direction. You enter because everything appears to agree. Then price stops. It hesitates, refuses to extend, and suddenly moves the other way. The uncomfortable part is that the warning was already there. The volume itself was not the signal. The market's failure to respond to that volume was. There is a difference between activity and progress. When a market trades unusually heavy volume but gains very little ground, you should pay attention. Something is meeting that pressure. If aggressive buyers keep lifting offers but price cannot advance, there must be enough supply entering the market to absorb them. If sellers are striking bids repeatedly and price refuses to break lower, demand may be taking everything they offer. That does not tell you with certainty what happens next. Nothing in trading does. But it tells you something important about the struggle taking place beneath the price. Think of volume as effort and price movement as result. When the effort becomes large and the result becomes small, the relationship has changed. This is where impatient traders often make their mistake. They see increasing volume and interpret it automatically as strength. But volume has no opinion. It records participation. It does not tell you whether that participation represents continuation, liquidation, accumulation, distribution, panic, or absorption. You have to judge what the price accomplished with all that activity. Suppose, hypothetically, a stock has been rising steadily toward a previous high. As it reaches that level, volume expands sharply. At first glance, that looks bullish, but now watch the details. Does price continue advancing easily? Are closes holding near the highs? Or are thousands of additional transactions producing almost no upward progress? If volume doubles while price barely moves, the important information may not be the buying you can see. It may be the selling required to stop it. That distinction changes how you behave. Instead of chasing the busiest candle, observe what happens immediately afterward. Does price leave the high volume area with conviction? Does it repeatedly return to the same level? Are attempts to continue being rejected? Is the market accepting prices above the level, or merely touching them before falling back? You are not trying to predict from one bar. You are watching a sequence of cause and effect. Heavy volume followed by effortless continuation tells one story. Heavy volume followed by stalled progress tells another. And when that stall occurs after an extended move, near an obvious level where traders are already emotionally committed, its meaning deserves even more attention. The useful habit is simple. Whenever you see exceptional volume, resist the urge to ask, is this bullish or bearish? Ask instead, what did all that trading actually accomplish? Because before some of the market's most important moves, the first clue is not that price begins moving faster. It is that enormous effort suddenly stops producing the result everyone expects. And once you learn to recognize that imbalance, the next question becomes far more important. How do you tell whether you are watching genuine absorption, ordinary consolidation, or the beginning of a trap? A sudden increase in volume can look important simply because it is large. But size alone tells you very little. The first question is not how much volume appeared. The first question is where it appeared. Consider a hypothetical chart where price has been moving sideways for several hours. A volume spike forms near the middle of that range, but price is still surrounded by recent trading on both sides. Buyers have no clear level to overcome, and sellers have no clear level to defend. Activity has increased, but the market has not reached a place where a decision is required. Because of that, the volume may reflect little more than two-sided business. Now move the same volume spike to the upper boundary of that range. Price is testing a level where previous advances stop. The situation changes because traders now have something specific to act on. Existing longs may take profits. Short sellers may defend the prior high. Breakout traders may enter above it. Traders who were waiting for confirmation may suddenly become active. One price area brings several competing decisions together, so increased volume there carries more information. This is why structural location comes before the signal itself. You can make a practical distinction on any chart. Ask whether the volume event occurred at a decision point or inside an area of acceptance. A decision point is somewhere price has a reason to either continue or reject. A prior swing high or low, a clear range boundary, a recent breakout level, or the edge of a sustained directional move. An acceptance area is where price has already spent substantial time trading back and forth without resolving anything. The same principle applies after a strong trend. Suppose, hypothetically, price is advanced for several sessions and then reaches a previous major high as volume expands. That activity deserves closer attention than identical volume appearing halfway through the advance. At the old high, participants are forced to make new decisions because the market is confronting remembered supply and a visible reference point. This does not mean volume at an important level predicts a reversal or a breakout. Location improves the quality of the question. It does not provide the answer. A high volume event at structure should make you observe more carefully, not decide more quickly. So the useful takeaway is simple: rank the location first and the volume second. If unusual activity appears where the market must prove acceptance or rejection, it deserves attention. But once you have found that location, a harder problem remains. What does the volume actually mean when all that activity produces surprisingly little movement? Now suppose volume expands sharply, but price barely travels. That difference matters. The market is telling you that participation increased, yet the result of that participation did not increase with it. Volume measures activity, not control. A large number of transactions can occur because buyers are aggressive, because sellers are aggressive, or because both sides are meeting each other with unusual force. Price movement shows which side is actually gaining ground. When activity rises but displacement does not, the market is absorbing effort without producing a proportional result. Consider a hypothetical move into resistance. Buyers keep paying higher prices, volume climbs, and the candle initially looks strong. But by the close, the total advance is small and much of the early progress has disappeared. The important fact is not simply that buying occurred. The important fact is that enough selling appeared to prevent that buying from carrying price much farther. You can apply a simple distinction here. Compare effort with result. If volume expands and the candle range expands with it, then activity is producing directional progress. If volume expands while the range contracts, the close weakens, or net progress becomes smaller, then increased effort is meeting resistance. The same logic works on the downside. Imagine heavy selling entering after a decline. Volume surges, yet each push lower covers less distance than the one before it. Sellers are still active, but their ability to move price is deteriorating. That does not automatically mean buyers have taken control, but it does tell you that selling pressure is becoming less efficient. This is why a volume spike cannot be labeled bullish or bearish in isolation. The same number can accompany continuation or opposition. The interpretation comes from what price accomplished while that volume was being traded. Watch three things together: relative volume, total price spread, and where the candle closes within that spread. High volume with a wide range and a close near the directional extreme shows strong result. High volume with limited range and a poor close shows that the same effort produced less progress. That gives you a usable answer to the current question. The signal is not heavy volume by itself. The signal is the relationship between heavy participation and the amount of price movement it creates. But even that relationship can mislead when viewed on one candle alone. The next problem is deciding whether this loss of efficiency is genuine absorption, simple exhaustion, or nothing more than ordinary two-way trade. A high volume stall can come from several different conditions, and they should not be treated as the same signal. The chart may be showing absorption, exhaustion, or simply active two-way trade. The difference is found in the sequence around the event, not in the volume spike itself. Absorption means one side keeps attacking, but opposing liquidity repeatedly prevents further progress. Imagine, hypothetically, price pressing into a support area 3 separate times. Selling remains heavy on each test, yet the first push breaks 10 points, the second only 4, and the third cannot extend at all. Sellers are still active, but each attempt achieves less. That repeated failure is important because demand is showing an ability to take continued pressure without surrendering much price. Exhaustion develops differently. Here, the move weakens because the side driving it begins running out of participation. A sharp decline may end with heavy activity, followed by smaller volume and very little willingness to continue lower. The key distinction is repetition. Absorption shows pressure being actively met. Exhaustion shows pressure disappearing. Both can stop a move, but the mechanism underneath is different. Then there is ordinary two-way trade, which can easily be mistaken for either one. Suppose price enters a broad congestion area and volume remains elevated while candles overlap, highs and lows are repeatedly crossed, and neither side produces a sequence of diminishing advances against a fixed boundary. That is not necessarily hidden accumulation or distribution. It may simply be a market conducting business around a price both sides currently accept. So when you examine a high-volume stall, ask 3 practical questions. Is one side repeatedly pressing the same area? Is each attempt producing less progress? And is the opposing level remaining intact while that pressure continues? If all 3 are visible, absorption becomes a stronger explanation. If participation simply fades after an extended push, exhaustion becomes more plausible. If volume stays high while price rotates freely in both directions, you are probably looking at ordinary balance. This distinction matters because the label changes what the signal actually tells you. Absorption suggests resistance to continued pressure. Exhaustion suggests the existing move is losing fuel. Two-way trade suggests no meaningful directional advantage has yet been established. That resolves the classification problem, but classification alone is not enough. Even genuine absorption only tells you that pressure was contained. The next question is whether price can prove that control has actually shifted. Absorption becomes useful only when price responds to it. A market can absorb pressure for several bars and still fail to reverse. That is why the volume event should be treated as evidence of resistance, not proof that control has changed. Suppose, hypothetically, sellers drive price into a defended area and repeated downside attempts stop making progress. That tells you selling is being contained. But if price then remains trapped near the lows, buyers have not demonstrated control. The market has stopped falling, but stopping is not the same as turning. Confirmation begins when price starts doing something the previous dominant side should not allow. After bullish absorption, that may mean reclaiming a nearby breakdown level, closing above a short-term swing high, or producing a decisive upward range expansion. The cause is straightforward. If buyers have truly taken control after absorbing supply, they should eventually force sellers to retreat and move price away from the contested area. The same logic applies in reverse. After buying pressure is absorbed near resistance, a bearish confirmation would involve price losing nearby support, closing below a recent swing low, or expanding downward with less resistance than before. What matters is not the exact candle pattern. What matters is whether price begins accepting territory in the direction opposite the pressure that was absorbed. There is a concrete distinction worth making here. Rejection is not the same as acceptance. A brief move above a level, followed by an immediate return, tells you price tested that area. Several closes above it, or a clean push that holds away from the old boundary, tells you the market is beginning to accept higher prices. Confirmation becomes stronger when price can leave the volume zone rather than repeatedly falling back into it. You should also pay attention to displacement. A slow drift away from the area carries less information than a clear expansion in range, because stronger displacement shows that opposing orders are no longer containing price as effectively. The imbalance is beginning to express itself through movement. So the practical answer is this: absorption becomes a valid trade candidate only when price proves that the defended side can convert resistance into directional control. Until then, the setup remains unfinished. But once that proof appears, another decision immediately follows. Do you enter on the first break, wait for price to retest the area, or use a more refined trigger? Once confirmation appears, the next problem is execution. A valid setup can still produce a poor trade if the entry is badly matched to the structure. Enter too early, and you may be trading before the move is proven. Enter too late, and the market may already have traveled far enough to make the trade inefficient. There are 3 practical ways to enter after confirmation, and each solves a different problem. The first is the direct break. If price clears the confirmation level with strong displacement, you enter as the market proves control. The advantage is participation. The cost is that you accept a less favorable price because you are paying for evidence. The second method is the retest. Instead of entering on the initial break, you wait for price to return toward the reclaimed level or the edge of the absorption zone. The logic is simply, if the shift in control is genuine, the old barrier should begin acting differently when tested from the other side. A successful retest can offer better location, but the market may never provide one. Consider a hypothetical bullish setup. Price absorbs selling, reclaims a nearby swing high, and then pulls back. If that pullback slows near the reclaimed level and fails to push back through it, the retest is doing something useful. It is showing that sellers cannot easily regain the territory they just lost. The third approach is a lower, time frame trigger inside that retest. Instead of buying merely because price reaches the area, you wait for a smaller structural change, such as a failed push lower followed by a minor higher high. This gives more precise timing, but it also introduces more noise because lower time frames contain more short-lived fluctuations. The important distinction is between confirmation and entry. Confirmation tells you the setup has become actionable. Entry tells you how you choose to participate. Those are not the same decision, and confusing them often leads traders to chase a move simply because they were correct about direction. So choose the entry model according to what the market offers. A clean, forceful break may justify direct participation. A measured return to structure may favor a retest. A noisy pullback may require a more refined trigger. But whichever method you use, the entry only makes sense if you already know what price behavior would prove the entire interpretation wrong. Once you are in the trade, the most important level is not the one that would be convenient for your stop. It is the level that would prove your original interpretation no longer makes sense. Suppose, hypothetically, you entered long after selling pressure was absorbed near support and price later reclaimed nearby structure. Your thesis is that buyers defended that area and gained control. If price briefly dips back into the zone and immediately recovers, the thesis may still be intact. But if price pushes through the defended area, begins closing below it, and then fails to reclaim it, the market is behaving in a way your original idea said it should not. That is structural invalidation. The distinction between a test and a failure matters. Markets often trade slightly beyond obvious levels because liquidity is clustered there. A wick through support is not automatically proof that buyers have lost control. What matters more is acceptance. If price spends time below the level, closes there, and begins treating the old support as resistance, the evidence has changed. This is why arbitrary stop placement can create 2 opposite problems. A stop that is too tight may remove you during normal price testing, even though the structure remains valid. A stop placed too far away may keep you exposed after the market has already disproved the setup. The purpose of invalidation is to connect risk to the actual market logic rather than to a number chosen for comfort. You can make this practical by identifying the exact behavior that must not happen before entering. In a bullish absorption setup, that may be sustained trade below the defended low. In a bearish setup, it may be sustained acceptance above the level where buying was previously contained. The important point is that invalidation should reflect failure of the mechanism, not temporary discomfort in the position. There is also a difference between being early and being wrong. Price can take time to move without violating the structure, but once it begins accepting territory that contradicts the thesis, waiting for the market to come back, turns analysis into hope. So the takeaway is precise. Define the market behavior that would prove your interpretation false, and let that behavior, not emotion, set the boundary of the trade. Once that boundary is clear, the next question becomes mechanical. How large can the position be without allowing that structurally necessary stop to create excessive account risk? Once the invalidation level is defined, Position size should follow from it. The market decides how much room the trade requires. Your account determines how much exposure that room can support. Suppose, hypothetically, two setups look equally valid. In the first, the distance from entry to structural invalidation is 1 point. In the second, it is 3 points. If you trade the same number of shares in both, the second setup carries 3 times the price risk per share. The chart may look similar, but the account exposure is not. This is why conviction should not determine size. A strong-looking volume setup can still fail because every interpretation remains uncertain. Increasing size simply because the pattern appears unusually clean does not improve the signal. It only increases the consequence if the market disproves it. The practical relationship is straightforward. First, decide the maximum amount you are prepared to lose if the trade reaches its planned invalidation. Then divide that amount by the risk per share, contract, or unit between entry and stop. The result gives you a position size that matches the structure rather than fighting it. Here is the useful distinction. A wider stop does not automatically mean a riskier trade. A wider stop with a smaller position can carry the same planned account risk as a tighter stop with a larger position. What changes is the number of units, not necessarily the amount at risk. That matters because traders often make the process backward. They decide how many shares they want, then look for a stop that makes the loss feel acceptable. This can force the stop inside normal market noise or push it beyond the true invalidation level. In both cases, position size is dictating the analysis when it should be the result of the analysis. A second adjustment is necessary when the calculated size is impractical. If the proper structural stop requires a position larger than your limits allow, reduce the size. If transaction size, liquidity, or contract specifications prevent precise sizing, round down rather than increase risk to make the numbers fit. So the sequence is clear: structure defines invalidation, invalidation defines per unit risk, and per unit risk determines position size within a fixed risk limit. Once the trade is sized correctly and opened, however, the problem changes again. The question is no longer how much you can lose, but whether the market is behaving efficiently enough to justify continuing to hold the position. After entry, a trade can remain technically valid while still losing quality. That distinction matters. The stop tells you when the original idea has failed, but price behavior after entry tells you whether the market is progressing efficiently enough to justify continued confidence in the setup. Suppose, hypothetically, a long position begins moving away from the entry zone. The first advance is clean, the pullback is shallow, and the next push reaches a new high without much hesitation. That sequence is efficient because buyers are gaining distance while sellers are unable to force price back into the area where the trade began. Now change the sequence. Price advances, stalls, returns almost to the entry, pushes higher by only a small amount, then comes back again. The structure may not be invalidated, but something has changed. Buyers are spending more effort to achieve less distance, while sellers are repeatedly recovering ground. The trade is still alive, but its directional advantage is weakening. A useful distinction is between normal retracement and repeated re-entry into the origin area. A normal pullback gives back part of the move, but holds away from the original volume zone. Repeated re-entry means the market keeps revisiting the place it was supposed to leave behind. That matters because strong directional control usually creates separation. Persistent overlap suggests balance is returning. Volume can add another layer. In a healthy bullish move, advances may show clear range expansion, while pullbacks occur with less urgency and smaller spreads. If countertrend bars begin expanding on heavier activity while upward pushes become shorter, the character of the trade is changing. You are not predicting a reversal. You are observing that the side supporting your position is becoming less efficient. This is where management should remain evidence-based. Do not react to every small candle, and do not confuse temporary hesitation with failure. Instead, watch whether the market continues producing progress, defending gained territory, and limiting repeated tests of the original area. The takeaway is simple after entry: judge the trade by the quality of its movement, not merely by whether the stop has been touched. Efficient trades create distance. Deteriorating trades consume time and activity without producing proportional progress, and that creates the next decision. When weakening efficiency appears near an important opposing level, at what point does managing the trade become an exit decision? A trade does not need to become invalid before an exit becomes reasonable. Sometimes the more important question is whether the remaining opportunity still justifies staying exposed. Suppose, hypothetically, a long position has already advanced into a prior resistance area. Price keeps pushing higher, but each new high is smaller than the last. At the same time, volume expands. That combination matters because more participation is producing less upside progress. The move is still rising, but the efficiency of that rise is deteriorating at the exact place where opposing supply is likely to matter. This is different from ordinary consolidation. If price pauses on moderate activity, holds most of its gains, and then resumes higher, the market may simply be resting. But if repeated pushes into resistance require increasing volume, while closes weaken and extensions shrink, the evidence is changing. Buyers are still active, yet they are no longer moving price with the same ease. The practical interpretation is not that a reversal is guaranteed. It is that the original directional advantage may be diminishing. That creates several possible responses. Depending on the trade plan, reduce part of the position, tighten management around nearby structure, or exit if the opposing evidence becomes strong enough. The decision should come from the market's changing behavior, not from the desire to capture the exact top. A useful distinction is between reaching a target area and showing failure inside that area. Price touching prior resistance gives you location. Increasing effort with decreasing result gives you evidence. When both appear together, the case for protecting open profit becomes stronger because the market is no longer rewarding continued exposure in the same way. The same logic works in reverse for a short trade approaching support. If heavy selling continues but downside progress contracts and price repeatedly rejects lower levels, demand may be absorbing that pressure. Again, the important point is not prediction. It is recognizing that the risk of holding may now be rising faster than the remaining reward. So the exit question becomes more precise. Not, how far can this move go? But, is the market still producing enough directional progress to justify staying in? That resolves the immediate decision. But one final problem remains. How do you review these volume response setups afterward so you can separate useful patterns from hindsight and adapt the process across different markets and time frames? After the trade is closed, the chart becomes easier to read than it was in real time. That creates a problem. Once you know the outcome, almost every important volume event can appear obvious. A useful review process has to separate what was actually observable at the time from what only became clear afterward. Start by recording the setup as a sequence of variables rather than as a win or a loss. Note the structural location, the relative volume, the amount of price displacement, the type of confirmation, the entry method, and what happened immediately after entry. The purpose is to preserve the conditions that produced the decision, because those conditions can be compared across future trades. Consider a hypothetical review of 5 setups. 2 began with similar volume behavior, but one occurred during an active market session near a clean structural boundary, while the other appeared during thin trading inside a broad range. If you record only the outcome, both may look like examples of the same pattern. If you record the conditions, you can see that they were never truly equivalent. This is where review becomes adaptation rather than journaling. You are looking for repeated relationships. Perhaps retest entries perform cleanly in one instrument, but regularly fail because another instrument tends to break and run. Perhaps a 5-minute signal becomes more reliable when it aligns with a higher time frame level. Perhaps certain high volume events produce movement only during specific parts of the session. The concrete distinction is between process quality and trade outcome. A losing trade can still be well executed if the conditions matched your rules and the market simply failed. A winning trade can be poorly executed if you entered without the required evidence and happened to benefit from the outcome. If you judge only by profit or loss, random success can reinforce weak decisions. Over a meaningful sample, Review should answer one question: which combinations of context and response deserve your attention, and which should be filtered out. That is how a broad idea becomes a narrower playbook based on evidence you can actually observe. The takeaway is to review variables, not stories. Record what the market showed, what decision you made from it, and whether that decision matched the process you intended to follow. Once those patterns begin to repeat, the next challenge is applying the entire sequence in real time, where location, volume, confirmation, execution, risk, management, and exit all have to be judged while the chart is still unfolding.